Okay, everyone. Thank you for watch my channel. This is Luis Cryptolou here. Now you see my face. So it's gonna be kind of weird to do a video because I think I'm not looking at the camera right now. So I have a lot of screens going on, got a lot of situation going on. But so right now, no further ado, let's move to you guys a video that I kind of want to show. Just I think before that the closing. I think this was a little bit earlier. I took myself out. And let's take a look.
These stocks have gotten a little ahead of themselves on what will turn out to be false hopes.
So we're in this moment right now, and we've been in this moment for a little while, where we're back to higher interest rates on, let's say, the 2-year, the 10-year, negative for a certain type of stock. Big stocks, important stocks. But then when those rate fears ease for the day, it's like a green light to go out and buy them. It's very reminiscent, Judge, and you'll probably remember this, of the risk-on, risk-off stuff from 2011, 2012, when on a Monday it would look like Europe is Armageddon, and then the next day European currencies would rally, and there would be this like whole group of stocks you could just blindfold yourself and buy any of them. We're doing that now with interest rates, and it's fun. It's interesting. Eventually, everyone learns the game and it stops working. But look at today. You get the rate fears cool off a little bit. What are your top 3 leadership groups? Surprise to surprise. Real estate number 1, up 1% on the day. Consumer discretionary number 2, up almost 1%. Number 3 is industrials. Number 4 is tech. It's like surprise, surprise. So today
Russell.
So here's what I want to do. I want to coin the term. We're going to call it cut on, cut off. Today is a cut-on day, right? You got a little bit of easing in rates. People are a little bit more sanguine about, what's happening with the inflation story, and they'll let these stocks run. If you get something that seems to be negative on the inflation front, or tomorrow's jobs report is a blowout number, or average hourly earnings are way ahead of schedule, you're going to see it be a cut-off market. And you're going to see industrials down big. They'll crush the real estate names. They'll hit consumer discretion. So this is the new game. I hope you all learn it. I hope we can have this game for, I don't know, as many weeks as we have until June, July, and then eventually it'll end. But that's what's happening right now. And you could track it yourself on your screen.
So if it's that binary,
cut
right,
on today.
as you suggest, right? Rates up and, cut off, rates down, cut on. So, Liz, do you feel like we are vulnerable? Whether it's Kerry expressing it through selling or trimming some names that have gone up a lot on these hopes. Josh laid it out pretty well. The market is obviously super sensitive at this moment about higher interest rates because it's traded a little uneasy as rates have backed up. Well, they're back off, and here we are green again.
Yep, and if you look at something like the MOVE index, which is the volatility in yields, that's gone up quite a bit this week. And even though we have a little bit of a back off in yields today, we're still up 15 basis points in the 10-year this week. That is a huge move in Treasury yields. So far, it's been a short-term change in trend, meaning yields up, stocks down. That's the change in trend. The year-to-date period saw yields up, stocks up. So I don't think it's definitive yet that that's what's occurring, but I do think that the market is going to run out of patience for this waiting period. We somehow digested going from 6 cuts to 3 cuts very easily, and at some point we continue to keep pushing these back. I think really the bigger risk, what we are at risk for, is a reheating and a reacceleration in inflation that extends beyond the February numbers, because those were explained away by seasonality. If we get hotter inflation for March, we get hotter inflation for April, I think you're going to start to hear conversations about actually hikes coming back into play, and that will make people very nervous.
That would be super cut off.
That way cut off.
Look, you've just talked about, it was weeks and weeks ago, about the biggest risk you see is the possibility that we do have reigniting inflation
that is
more sticky than people think, and then the Fed's got to either act on that or just keep rates much higher for much longer than even people suggest.
That is the risk, and I think if you listen to what the Fed had to say the last time They had the presser.
Everything in the moment, everything in the moment was green, as you can see. Every single market, it was green. I think it was around 11:30, 12 o'clock.
I don't think the market believes them, quite frankly. So I would be looking to tomorrow, and don't worry about headline. So we're looking for 216,000 jobs. Don't worry so much about that, because if that's at 300,000, no one's going to fall out of a window. Look at average hourly earnings. Look at hours work. Like, look at the stuff that's really going to filter into PCE in the near term. That's the stuff where the market really might not like it. To Liz's point, she's exactly right. And I remain of the thinking earnings are not the risk. It's just it just isn't. International stuff is not the risk. This is the risk that the Fed says, you know what? One more wouldn't kill anyone. And we're back to talking about when is the next 25 basis point hike. I don't think we're there yet. I just think if you want to worry about something, that's the thing you should worry about.
So how should we view the markets here?
Well, as Josh has said, tomorrow is big for near-term trading. But one thing I like, what I've seen within the CME Group's Fed Watch tool, is you have a 55 to 60% probability of 3 cuts this year. So it's not like it's really fully priced in. So the market is being prepared for some hotter data. Now, in the last couple of days, again, to your point, and the cut on as jobless claims a little higher than expected, services data a little lower than expected. But with all of this happening, CPI and PPI have started to nudge up a bit. And I look at 3 being a trend. We've only had 2. So I think the next couple of weeks here are going to be absolutely crucial for this market.
It would have been a tech check, but let's cut off. So, I don't know if you guys want to see me, but let me stop this one. Actually, just a second, guys. Bear with me. Let me do something. Let's go live. Just in case anything important coming up. I want to see that. This is very important.
It involves Palantir moving some workloads running Foundry, which is its software platform from corporate data analytics applications, to the Oracle Cloud for the first time. Palantir also will make its Gotham software for government customers and its AI software deployable on the Oracle Cloud. Now, it's a cultural fit, in part because both companies are focused not just on commercial business, but also on investing in and building out their government businesses. Oracle has a big international government book of business, for example, so this tie-up could actually garner more contracts in defense and intelligence from U.S. allies and international markets. Palantir Executive Vice President Josh Harris telling me this morning, quote, "This could be a game changer for the international government and defense landscape just to start. And we are already seeing positive reception on this combination 3 hours in." I spoke to him earlier today on the heels of that announcement. Shares of both companies, though, turning lower amid the broader market sell-off. Up next, Mike Santoli on today's spike in volatility and what that could mean for the market. And speaking of defense, as we do go to break, let's take a look at defense stocks, which closed higher today amid those geopolitical concerns. L3 Harris leading the way, up 2.5%. Stay with us.
Okay, so that for me, let me come into the picture. All right. As you can see, a big candle print right on the day chart. So we have this big 1.23%. We have pretty much every signal, all those indicators kind of, as you can see here, sell. Those 2 arrows, I got one here, another here. And we have this trend line, that's the black one right now, going across the big candle. So we got sell here, and the trend is going to cross here, this one. This is on the day, And as we're looking at SP 500 SPX, let's take a look. Let me see. Let's go SPY. Same thing, as you can see it. I actually, in the fake money, open a position right here at the top, and I was right. Sell, sell, sell. Everything sell with again the trauma line, line going through this. What CNBC pointed is the VIX. Okay, the VIX, it's the volatility on the market. And the geopolitical, it's heating up in the Middle East, and I think that is some of the reason the VIX was kind of like picked. Today, the VIX jumped 14%. So it's trading. The bottom was something around $12, a little below here, $11.93. Then we have this big buy block over here, the bull block on the VIX, which is, you know. And now we have a 1585 as a support. The next resistance is 1791. So we see what's going to happen. Well, tomorrow is Friday. See what's happening over the weekend, and let's see what happened next week in the whole situation. I'm still thinking that I believe I don't know if this is the day. This is not gonna split. The VIX not gonna split, but the UVIX is gonna split. I remember also when the VIX is split, it kind of like pushed the price up in the market. I think more the VIX than the UVIX, but let's see how it works. So the UVIX is this one right now that you guys watching, and let's zoom in. Again, we have a support down here, 691. Also support here, 665. The buy position was $6.19. The big block, the bull block was here. So the next resistance we didn't hit today, but I think we did. Let's see. Let's put the day chart. Now we didn't hit it. Anything close? It was 755 on 1 hour. No, yeah, we crossing this bear block over here, and the next one, as you guys can see, 762 is a big block, big bear block in over here. So I don't know what's acting like that, but so that's what we have right now. And that's the day chart. So they saying the SP 500 is down 2% this week. Let's take a look.
Staying relatively, kind of undisturbed. You did see some premium in the VIX. So I think what I would say is, it probably doesn't take a lot to get people just to have a reality check and say maybe this is just a standard, standard pullback. I do think that those sentiment measures you mentioned, it's very tricky because they are elevated. Forward returns, when they're that consensus bullish, tend to be weaker than the average. On the other hand, they can always get more extended, and they can stay there for a long time in a bull market. So it's really tricky to use as a timing device. It's much more about, okay, here are the atmospheric conditions where the surprise might come from the negative side because people are already pretty fully invested in the bull market.
Okay, so in light of all of this and everything else we've been parsing through over this hour as we digest the late day sell-off that we saw in equity markets here. What are you watching tomorrow? I know we have jobs, but also that Lamb Weston earnings report this morning kind of, I guess, it started the undercurrents of concern, at least where the consumer is concerned in trading today, too.
Right. And I think because it was also added to some other recent sort of soft warnings, whether it was Ulta yesterday, just this idea that the consumer is either taking a stutter step in its spending or is getting a little bit fatigued and is starting to wear on some consumer population. So I do think that's worth keeping an eye on in light of the jobs number tomorrow. I think the first thing I'll watch is the bond market's reaction to that number. How does it treat it relative to which way inflation and the Fed are going?
Okay. Mike Santoli, great to start the hour with you and end the hour with you. With all the major averages finishing today lower, the Dow actually posting its worst day since March of 2023. That's going to do it for us here at Overtime. Fast Money begins right now.
Live from the NASDAQ market site in the heart of New York City's Times Square, this is Fast Money. Here's what's on tap tonight. A late-day market sell-off. Major indices all taking a sharp leg lower late in the session as tensions between Israel and Iran ramp up. The headlines that send stocks tumbling and what they mean for
the
your
main
money.
reason.
Plus,
So let's take a look over here into charts that we're going to bring on to you, the chart master. So we have... we don't have nothing. We still have the CNBC playing. Okay, now we have this one is the DXY, which is the dollar. Still like on a day, not too shabby. Big resistance of 105, kind of like went down right on the support. That means something not really. Because when the market go down, the dollar go up. Actually, it went up, but come on. It didn't go up as much that we needed to see for the price and the market go like really, really correction of 2, 3, 4%. So that's one thing. The other thing is the other one. That is gold. Gold took a unbelievable shit in the sky. Can I say that? It's just crazy. From the $2,000 that kind of side trade for months went up almost, actually hit it. This one. The high was $2,305. That's kind of like blows everybody's mind. I was receiving some emails saying the gold or what I have back. I bought. I should have hold. I didn't hold. I sold it. Stupid of mine, but it's just crazy. I had the $200 call for April 19. So it hit at 211. I got cheap. I got less than $50 and probably paid $1,100 because it went up to 211 today. Anyway, forget about it. The gold exploded. Dollar kind of like hold right there. Let's see. The 10 years. They talking CNBC talk about 10 years and job. Non-farm payroll is supposed to be 200,000 plus. Unemployment rate 3.8. I don't know if this is going to be what they accept. I think the number is going to be way low, way high in the payroll. And the average hour wage year over year 4%. I think that's going to be the price. Let's take a look what they're saying right now.
I think that's often good. I think what happened in bonds, though, later today was the flight to quality somewhat. And so that's a bit noisy. But I think I guess what's the frothiest place out there is NVIDIA. I guess so it makes sense to me that would sell off. But even so, this it hasn't been trounced completely. So I think if we do get in that really difficult environment, there's more to go in NVIDIA to the downside.
Yeah, that idea that big cap tech is your place to be when times are tough. I don't know. Today we saw the Philly Semiconductor Index down 3%. We saw communication services down, information technology down. Those are the sectors that led us lower here. So it didn't come through here, at least today, especially when you have not just Kashkari sort of underscoring those concerns that maybe we won't get 3, maybe we'll get 0. And then you overlay with that the geopolitical tensions, which, by the way, is a CIA warning that Iran could attack Israel in the next 48 hours.
Well, yeah, and the geopolitics are really tough to handicap, but we talk about that on this desk, which is the dynamic here that I think if we could just keep it contained, I think we could maybe start to make heads and tails out of at least trying to handicap certain events. But I think this was 6 Fed officials that followed after Powell yesterday who put the wheels in motion. I mean, he called out his crew and said, I need to reinforce a message. And I think the Fed recognizes, let's not forget that the Fed targets financial conditions when they want them on the upside. They want to goose the wealth effect. They do it. They've done it before. And the flip side of that is the stock market's been out of control. So I thought the most interesting comments of the 6 that spoke today was probably, Austin Goolsbee, who tends to be, pretty dovish, and yet got in there and said, things look not too bad. I think, these 2 inflation prints from January and February, not that big a deal. But said, if these housing numbers don't improve, we're never going to get to 2%. When you heard Mester, who ultimately came in there and typically has been one to be more dovish, said, I could wait a couple months. That really means probably she could wait longer. And then, of course, Kashkari, who used to be the biggest dove out there, now is the big hawk out there. So it's fascinating that the Fed and the conversation, that not just us, a lot of people in the market have been having for a month, is that maybe 0 cuts. I think it's interesting. Yields can go lower before they could possibly even go higher. And at a day like today, the market thinks a couple steps ahead and says, look, if they're not going to do anything, we get it. We've got problems with inflation, but we will have problems with growth.
Yeah, the market might take some solace in the fact that Kashkari, who couldn't have been more wrong a couple years ago, so maybe he's equally wrong now. But we haven't, well, I shouldn't say we, I haven't been a fan. I've been on record. With all that said, defense stocks, big day today. And look at the move in crude oil on top of the move that we've been seeing. So that's making the Fed's job more difficult. Throw on top of that the recent move in copper, some of the soft commodities that we've talked about, and then you have an understanding as to why it's very difficult to lower rates in this environment. And yields, to Karen's point, I think the reason why they did go down today was this perceived or the perception of a flight to quality.
The bar is very high in terms of March. The inflation data for the month of March coming in better than January and February, in that it should be lower. And now I don't know if we're going to see that, considering we had this sort of swing that there's no reason for it to come down at this point.
Yeah, think about the last few years, though, some of the inputs or some of the causes of higher inflationary sort of things, right? It has been geopolitical, right? So we go back to early 2022, we go to some of the stuff that's going on in the Red Sea. So if there is some sort of situation, and again, it feels like we had not been talking about this Iranian threat, you know what I mean? Especially as the war in Gaza kept on going and going, that sort of thing. I mean, anything that happens in reaction to that, save from the horrible human effects of that, is going to be inflationary for the globe, you know what I mean? Whether it's energy, whether it's food, whether it's, that sort of thing. So to me, like, that is when we talked about this a little bit last night, it was like usually in these periods, right, when we come from these like kind of rate hiking to pausing, and then when they start to cut, we go back, to 2000, 2001, you go back to 7, 8, you go back to 2020. These are things that we could not have foreseen. And we know that there's plenty of geopolitical hotspots out there, but this would be a very different situation because in those prior 3 times, we were not dealing with inflationary pressures to the upside. If anything, they were to the downside. And that's what's different this time.
Right. And then, of course, under all of this is if we do get embroiled somehow in some sort of conflict, is that even more reason for the Fed not to cut? Because you want to save some dry powder for a time when the economy might actually need it. I don't know. It's a very complicated sort of mosaic.
Right, it is. I mean, well, particularly if what Dan's saying is true. If we get mired in that and that causes additional inflation, then yes, why cut?
And just to remind folks, and this isn't my political view, this isn't anything, but the fact is if the U.S. is taking a hotter line stance with Israel, that throws into question a lot of political kind of givens in the world and historically, and I think that's part of the volatility around this. So I look at also some of the relationships. Guys started to talk about the things that did well and things that didn't do well. As an energy investor, I don't love this kind of price action, okay? And energy, actually, XLE, which was cruising going into the morning, didn't really respond too well to this kind of news. So I don't think we love price spikes in the energy space. I think what we've liked are really the dynamics around some of the fundamentals in the sector. I do look at the broader market dynamics here and say, look, today was an interesting day, and we talk about the geopolitics. I think this was all about the Fed. And was today the day? Because we've said this for a while.
This move today was about the Fed?
I think it was all about the Fed.
I mean, we've had people coming out, Bostic yesterday, Gorman. I mean, a number
zero or
saying
less
no
than
cuts or
but we had 6 Fed officials today who basically reiterated what Powell said yesterday. I
thought was more dovish.
Well, look, what I'm going to tell you is I think we've questioned why equities haven't responded to the dynamic that actually there might not be rate cuts this year when, in fact, they've priced in 6 or 3 or whatever. And at some point, equity markets have to respond. I'm not making light of the geopolitics. I already brought it up. But I do think this was a broken record by the Fed today.
But part of the conversation that we've had here is the answer to the question of what would the markets do if we said tomorrow that there would be no cuts? And we all said, not all, but many people said that the markets would do fine because that means that growth is actually intact. That story remains intact. So what is different today? If it's the Fed today, what is the difference between today and before? Because
the Fed's data dependent, but they're not data dependent. They're kind of saying we're going to wait either way. We're scared to death about, you said this yesterday, we can't cut too soon. I do agree with what Guy said, too. You're making a great point to remind us that we said a zero-cut environment means that the economy is better. But a zero-cut environment also means that the Fed is boxed into a corner, and we actually could have slower growth and stagflation. And that's what the market did today. Look what bond yields did and look what equities did, and that's stagflation.
Yeah, I mean, historically, the cuts are because something's breaking, right? And the bulls will say they can cut this time because nothing's breaking. Things are moving along really nicely, and they can start to, I don't want to say normalize rates because I don't think lowering rates is anything near normal, but they can do that because there's nothing to stop them, right? The economy's doing well, unemployment's under control, all those things. That's the best case scenario. But I don't think, that's the thing. I don't think that's what's going to happen. If they lower rates, it's because something is breaking along the way. And you're starting to see, signs of that today. And real quick, in terms of energy, Tim makes a great point. If we have an XLE chart or an ExxonMobil or Conoco, both these names, Exxon and Conoco, are right up against prior all-time highs. The laggard has been Chevron, which made its all-time high right around the time, if you recall, I think it was November of 22, when they announced a $75 billion stock buyback. That marked the top. But these stocks are right there. I think they're going to go through, but I can understand why you might want to take money off the table.
All right, let's get more on the move. And oil prices, WTI trading above $86 a barrel, Brent climbing above 90, both at their highest since October. For more on this, let's get to CNBC's Pippa Stevens. Pippa.
That's right, Melissa. Brent settling above 90 for the first time since October as fears of a wider conflict in the Middle East spooks the oil market after Iran vowed retaliation following a missile strike on its consulate in Damascus. When asked earlier today if the CIA warned Israel about an Iranian plan to attack within 48 hours, National Security Council spokesperson John Kirby said, quote, they did talk about a very public and very viable real threat by Iran to Israel's security. BOK Financial's Dennis Kistler said the retaliatory actions will most likely involve the oil complex in some manner, whether it strikes against more Red Sea shipping lanes or directly on the Strait of Hormuz, which is adding fears that it will disrupt transportation of crude oil and oil products. Melissa?
Any guesses at this point, Pippa, on what the impact to Brent would be?
I think at this point we have to see if any infrastructure is actually hit and the nature of any retaliatory actions. I think after Russia first invaded Ukraine, there was a lot of fear in the market that all of a sudden supplies would be disrupted, which is why we saw prices get above 130. That did not end up happening. So I think this time around there is more hesitation to jump fully in. But clearly the market right now is saying maybe this is a little bit more of an issue for oil than previously thought.
All right. Pippa, thanks. Pippa Stevens. We were just talking about the spike in oil. We're better off just having a high level of oil and not a spike. But
no, and that's the point Tim making. I still think it's going to be. I think it's going to wind up bullish for the energy complex and XLE. But I understand. And quickly, defense stocks. Throw up at Lockheed Martin, for example. Good day today on the back of what's been a good couple of weeks. So I think defense stocks have been trying to tell you something along the way as well.
So you're saying if tomorrow we wake up and nothing's really happened, do you think then oil will retrace entirely, or do you think there's going to be some level of elevated oil?
I think oil wants to go to these levels. It's been on that trajectory for a while. It got sort of fast-tracked today, but I think whether it happened today or a week from now, 2 weeks from now, I think that's where we're going. Tim's point about, this is not the environment where you want necessarily, but I understand that. But this rabbit's been out of the hat for a while.
Yeah,
I guess what I'm
it's
saying.
more that if you're investing in energy equities, you don't really like a spike in oil because it's never given the benefit of the doubt. And so energy equities, I think, have been moving higher on a combination of steadier oil prices. Whatever you believe OPEC can and cannot do in terms of controlling supply, you believe that these companies are in a pretty good spot, and that actually the biggest integrated oil companies for the last 3 years have been paying down debt and putting themselves in a very defensive position in terms of their dividends.
All right, meantime, Meta eking out a gain in spite of today's sell-off. The stock hitting a record $530 during the session after catching 3 fresh analyst upgrades. Mizuho naming it a top pick for April, while both RBC and Jefferies hiked their price targets. Jefferies saying it expects Meta to capture 50% of incremental ad dollars in 2024. That's well above the 33% it got in 2023. So very bullish here. We saw that it was up as much as, I think, 4+% during the session, Karen.
Yeah, I mean, I like that. That's sort of the headline number of the piece. But also what it says is that so earnings will go up, of course, yes. But then it has a 23 multiple, which is really not a very, expensive multiple for a company like this. So that was the base case, that 585 target. Right. And in fact, they had a $715 bull case, the upside case, and I think 375 on the downside. But there's a lot to like there. And that didn't even include the cash.
Yeah, it's interesting. And this stock gapped up 20% after it reported its Q4 results and gave this guidance. And so here we are, we're trading at all-time highs. And again, I think the valuation story, I think what they've done, rationalizing costs, how they're using generative AI, like all this stuff, it's all there and it's cheap. I get it. But I just think it becomes incrementally that much harder to kind of surprise the way they did to the upside from an all-time high, or near an all-time high last quarter. And the other side of this is Alphabet's kind of stuck in the mud. Alphabet hasn't had that moment. They've had 2 consecutive disappointing quarters, 2 disappointing guides, a couple disappointing launches of their generative AI or whatever. And so it's as high as the expectations are getting for Meta, they're getting very low for Alphabet. And that could set up really interesting as we get through, let's say, a couple rocky weeks of volatility possibly and get into earnings, because to me, these could set up as decent pairs trades in the near term.
Right. When you talk about Alphabet, is it because they're trying to sell basically an AI product, and Meta is just trying to benefit its business with AI, and that was
which is working.
Which is working,
yes.
Right? Which is working in terms of selling ads for Reels. It's working for a lot of different things, Advantage Plus, and so that's sort of thesis. So it's interesting to think about AI as a product. And some companies are benefiting from that. And then this is just the application of AI to one's business, which is probably what we're going to see a lot more for a lot of the other companies outside the Mag 7.
Karen talks about this a lot, when stocks should or shouldn't be at certain levels. So if you would take away that obviously huge drawdown in Facebook, most of it because of their own mistakes, and just looked at this stock, you'd be like, it makes perfect sense that it's here. But we're looking at it through the context of this ridiculous run that it's had from the low. So it looks like parabolic move. But with that said, 21 times next year's numbers-ish, right? You're probably talking about, 15% EPS growth, 12% revenue growth or so. And as Karen said, that's without the cash. So there's nothing not to like here other than the fact it's had this tremendous move higher.
Yeah, it's interesting that we can say at 21, 22 times it's not expensive. It's not. But that didn't matter when it was 14 times. It really just tells you that I think they're in the sweet spot in terms of where, first of all, this was a company that everybody knew about, what the DAUs, the MAUs, whatever you're tracking, that this base of customers is so powerful. It's a cash flow machine. If they could ever decide just to be a company that wanted to generate free cash flow, well, they said we're going to go out there and do it. And then they also had core businesses they were working on that really are benefiting from AI. I'll say this about Google. I mean, I look at that chart. There's nothing about that chart that bothers me at all. I still think Google is one of these names. I mean, it's been easy to malign them, and it's understandable. But again, as they begin talking about pricing or not pricing, what AI could mean for their core business, I think there's catalysts there.
Do you think that it's not good, that Meta is not going to do much better from here because of the run that it's had?
No, I think you make a really good point. The way that they built this Llama, this model, it's open source. There's going to be a lot of applications that are built in and around that, but that's something that is, like in the making here. What they're doing right now for their own ad product is the thing that I think has been realized. It's been realized in that guidance. So I don't really have a strong sense. I just think it's interesting that there was a few analysts out today, and they were talking the same way they were about Meta, and they were all kind of downbeat a little bit on Alphabet. And the one thing I'll just say is if Google were to do this deal that was rumored a couple weeks ago, something with Apple, you know what I mean? This could be a really interesting time at at a really interesting valuation, at a really interesting sentiment level for this stock right here. So that's the way I'm thinking about it. I think Meta, if you're there, fantastic. If you're not in Alphabet, there might be an opportunity. But even if it gaps down on its third consecutive miss and guide down, it's probably not a bad do at that point also.
Coming up, the battle's been won, but now what? Disney CEO Bob Iger weighing in after coming out on top in the Nelson Peltz proxy battle, and now he's setting his sights on the media giant's next big hurdle. More on that next. And some stock moves catching our traders' eyes, a potential tech deal, a casino call, and a food processor plunging. We've got it all when Fast Money returns.
This is Fast Money with Melissa Lee, right here on CNBC.
So what we have here, we're looking at Disney. Let me see if we look at Disney. No, we don't. Now we look at Disney. So Disney had the proxy vote, which Bobby Iger won. I had play on this at 119, 118 put, and 127. Some reason I closed my put too early again, one more time, and I definitely made a mistake. However, to not making the whole thing lost, I got another one for tomorrow at 116. I didn't close. That was trading at 3 cents. I got for 20, so losing $17. But it went down. The stock went down to lows and closed at 117. If tomorrow the economy with this job numbers didn't come, wow, this is probably going to be diving. And I say the next support and the day chart, it's 113. So that's pretty much how it goes. I was kind of explaining when I was made a video early and open that was working on my thoughts for the what can I say? I already make $100, and I had a second position for next week in the bull side. But I say, let me cover just in case this stock don't go up. It looks like will it be rebounds from the bottom. The bottom looks like a 118. So eventually, apparently, like didn't hold the bottom. It just now wrap it down. Indicators don't lie. My indicator right there only didn't show me the sell. But I have an arrow. My arrow, it's showing in a day chart right here, the sell position. And I get in this one, I should have kept it, but it was for next week so far. But anyway. But guys, I'm going to wrap up. I'm going to watch the news. Take a look at some other things for tomorrow. And they talk about Disney right now. Let me show it to you guys.
Double-digit margins then, right?
Eventually, yes, double-digit margins, of course. The way to do that is actually very, very clear to us. It's very, very clear that we need more engagement in terms of consumers spending time on the platform.
But despite his loss yesterday, Peltz said he is not backing away from advocating for change at the media and entertainment giant.
I hope Bob can keep his promises. I hope they can do all the things they assured us they were going to do. And we'll only watch and wait. If they do it, they won't hear from me again. If they don't, Jim, you may be seeing me on your show next year doing this same thing again.
So can Disney succeed in its execution plans? I mean, he, at least right now, hopes so. He's got a $3.5 billion stake. at last filing.
Well, yes, and he's going to continue both because this is what he does for a living. He's got a lot on the line on this one. But any expectation that you're going to have a different outcome today, I think was off base. I think this isn't a real surprise. It's also interesting to hear Bob Iger say, now we have to do like as if suddenly now that this is out of the way, suddenly everything becomes a lot clearer. I think he said. Some of these messages have been said for months now in terms of costs and profitability dynamics. And I think that last quarter of earnings has as much to do about where the stock is than this proxy fight.
Yeah, I think so. It was a great interview. I mean, David really pushed him hard and on a lot of different things. One that I thought was interesting, it's not so newsy, but the idea that they hope to be number 2 in streaming. He didn't really say it like that, but that was sort of the way David framed it. And it's over, right? Netflix has won. So they're hoping to be number 2. You wouldn't think Bob Iger would say, we're going to turn this around. We're going to make it be number 2. Well, they're already.
But don't they have a lot of other levers? When you think about Netflix is trying to get into live, right? And they might be bidding for sports. And if you think about the thing that they're trying to fix and they're trying to monetize is that ESPN in a way. So to me, I think that it's kind of easy to just say, okay, we're number 2. But at the end of the day, if he's successful in transforming this business and getting to some of those things, they're going to probably do something a little bit better, and they're going to be in a better spot than Netflix to kind of do something horizontally, in my opinion, on the streaming front. But again, and I'll just say this about the stock, after that quarter that Tim just mentioned, the stock gap from 100 to 110 consolidated a little bit. This proxy fight started. It went to above 120 or so. If it were to come back, by the time you get to their earnings in early May, it gets set up as a great thing. They're not going to lay an egg on that next quarter. Think about that. When Bob Iger's on that thing, so you almost.
This last quarter was the one where they couldn't lay an egg.
Well, that one too, but right. I mean, he's got a little honeymoon period, a little coverage. But I'm just saying, if this thing were to come back in towards 110, then it sets up as a great entry point, in my opinion.
The interesting day for me will be April 18th. So Netflix reports on the 18th. Stock has had a huge run. We've talked about as it gets towards 32, 33 times next year's numbers, historically, that's when it starts getting expensive. And we're pretty close to that now. The prior all-time high is probably another $50 or so from here. So if Netflix stalls but Disney hangs in, that's a bit of a tell here. So I'm one of these people, I think Tim might agree. I think you stay long Disney here into earnings in early May.
All right. There's a lot more fast money to come. Here's what's coming up next.
A potential tech deal, gambling on a casino stock, and a potato processor getting fried. How our traders are handling today's big moves and Wall Street calls. Plus, big hopes for small caps. Why our next guest sees a turnaround on the horizon. And where you can set your sights within the space. You're watching Fast Money, live from the NASDAQ market site in Times Square. We're back right after this.
Cool. All right. That's what I have on that's what I have over here on my option strat situation. So I have the BlackRock is already, like I told you guys, dead. Disney total returns minus $1. Today I got $50 back. Play the 40 put still zero that in water because play even deep 5% kind of holds up pretty good. This one was interesting because I think it was dead in the water. Now it's I don't know, it may come back. Tesla, yeah, dead. And then UVIX, I added a second position early in the morning at $18. So that down my average. I think my average went down big, but still I'm pretty good with the 100% profit, as you guys can see. And I think it's easy to visit this number tomorrow, $8. Very easy, 15%. That went up today, 15% today. So easy for tomorrow, get the same weight. All right, guys. Like I said, thank for watching my videos. If you ever watch, I do everything live. And see you next time.